Good evening and welcome to Traders Group. We've got some pretty important analysis, I think, to continue on with, and that's primarily our expectations of the S&P 500 and the identification of both investment and trading opportunity, which is presenting itself in the near future. And I believe it's an opportunity which if you are not taking advantage of, you're going to be very disappointed with yourself in the next months to come. But just starting with the drivers, the fundamental, these are global macroeconomic drivers, the big picture stuff like Brexit, North Korea, China. And there's a new one that's just coming onto my horizon at the moment. First of all, I've already mentioned, we've discussed Brexit many times. We know UK and European markets have come up heavily in response to the expected Brexit, and it's irrelevant, I think, what actually happens, whether they have a hard or a soft. The markets have already factored in the negative. That's what they do. And the European markets are rising very, very strongly because, generally speaking, global portfolios would be underweight UK, especially UK stocks, and that's being addressed. North Korea has gone a bit quiet, but it's once in a 50-year opportunity for the North Korean dictator to engage with a president which will listen to them, and that's Mr. Trump. I thought the negotiating technique of walking away from the table was brilliant and puts the North Koreans on the back foot, because next time they meet, they've just missed an opportunity. They are really under pressure to negotiate and compromise. China's an ongoing story. It's always a good story. The charts tell me that we may see some negativity, some positivity, but essentially that's unfolding in a positive way, and that's being reflected in the outflow of the Chinese chart. The last big global fundamental that I follow is the Muller report. Once again, I think it's absolutely irrelevant. It's focused on one individual, and one individual doesn't dictate global economic performance. Therefore, I don't even think it's great of any importance, actually. At the most, it may see a one-day pullback in the market if it's a horrendous revelation, but seriously, who cares? A presidency doesn't necessarily drive global economics, and I don't think it's to be looked at that much. Let's now talk about the major technical elements of global markets, primarily the S&P 500, because it dictates global movement due to its size. And having a look at the inverted head and shoulders pattern, which we've been now studying for many days, weeks and months. It's not something that's unusual or new. It has been evolving since the low in late December. And we are aware that different members of this community have been taking exposure to US equities. Those of you who have got higher risk adversities have been doing so since the very bottom as the market crossed the moving average. That'd be me. And those of you who have got high risk adversities would be waiting for the market to build a shoulder, and that's the question I most ask. Where's the shoulder? Well, markets don't necessarily build shoulders. They can do whatever they like, and I pointed this out from a pattern in 2014. I could even make this out to already have done a shoulder. It's in the eye of the beholder. Technical work is not precise in terms of, just because we've got a large volatile left shoulder does not mean we've got a large volatile right shoulder. And the most important point of this current market is that the market has started trading and closed above the neckline. There goes that's called a breakout. That's officially a breakout. Now, from now on in, the strength of this breakout is dictated by the depth of the pullback. And I believe, it's my belief, that tonight we're going to see the market go up again. And if it does, obviously I can't see the future, if it does, and if this market breaks into a new high in the next week, when we're standing here next week, maybe it comes back a little bit, maybe it comes back to the average, but if it does, that would be a very shallow pullback. And the shallower the pullback, the stronger the market. So if it bounced straight away and went up tonight, broke into a new high, that's a really strong market because it's finding support on the neckline, which is above or at the previous swing high in the market. So my belief is that we're heading into the period where shoulders, the discussion of shoulders is completing, and we're now into the rate of change of price, the upside and the strength of that move. If you would ask me what's the global negative fundamental that's going to stop this market, there is none. And I mean, there is elements to macroeconomic policy, and Alan's given me some good information which I'll read out in a moment. But generally speaking, technically, this market has completed its base, has broken out, and may continue on for many days, weeks and months into the future. Is that guaranteed? Of course it's not guaranteed, because you can't see into the future. I can only go back in last year, and last year the market went from February right through to October, and the usual story of instability in May, stay away, was, you know, just as it always is, a complete fabrication. It's a fairy tale, and the market just continued on up. And if that happens again this year, this is a period where we could see significant expansion, and is the point at which you'll add the majority of your yield to your portfolio if you are positioned in the correct sectors of the market. The correct sectors of the market actually is a detailed story which I will cover after I finish indices, because the US market is completely different to the local market in the Asia Pacific. I'm talking about the Australian market, and it's really confined to 4 sectors at this point in time. I'll do a detailed analysis of economic strength within specific sectors shortly. I just want to read out valuable information that Alan, this New Zealand Alan, has given me. Numbers of, I've got 2 Alans, I think we may even have 3 somewhere, that Alan, New Zealand Alan, has given me from something that he's read, but it's interesting, and I'll just read it out. It's a little bit long, but it's okay. Here we go. It's a fundamental. The US Federal surprising markets with a completely flat forecast for interest rate hikes and a slightly weaker economic outlook. In a unanimous decision, interest rate projections from the Fed officials fell to 0, even lower than a recent Bloomberg survey, which suggested 1 hike rather than 2, the Fed projected in December. There is also a clear, sorry, I'm just shifting my screen. There's also a clear shift from the projections from this time a year ago, as you can see from the chart below. Okay, so you've copied this. I haven't got the chart below. Views from voting Fed officials have clearly centered on lower and lower interest rate targets and become more concentrated around them. That has already occurred in the December announcement, and the rapid change illustrates just how drastic the changes between the start and the end of 2018 was. So thank you for that bit of fundamental commentary in regard to shifts and the Fed's stance on monetary policy. And if you listen to the news, I think that's reflected in today's news services. I heard a similar presentation in the midday news service, which I listened to at lunchtime today in Australia. Okay, so let's get back to this particular chart, because there is lots of opportunity. There's 2 forms of opportunity. One form of opportunity is trading opportunity, and the trading opportunity resides in shares that are the strongest stocks within the strongest industries within the strongest sectors of the market. That's where I'd focus my individual opportunity if I was trading individual shares. If I was trading indices or XPXL, I would obviously be using short-term indicators to pick points on screen where I think there's an opportunity. My belief is that's probably this evening or within 1 day, and the opportunity to trade SPXL is my choice of product. But that doesn't say I don't trade options. Of course I trade options. I do both. So sometimes I trade options, sometimes I do both. Last week I was doing both. But SPXL will be a focus if this market's about to have another leg up in the not too distant future. In the context of volume behavior around the index, what does it say? The most important piece of it, well, there's 2 important pieces of information I have. One's advancing and declining shares, advancing and declining stocks within the S&P 500, and there's a clear pattern in play. Going back 3 weeks, I've got 6 weeks of information on my pad, but just going back 3 weeks, 3 weeks ago there was 220 advancing, 252 declining. Last week 244 advancing, 229 declining. This week, 261 advancing, 212 declining. Now, you always hear me refer to the volume of the numbers is equally or more important than the numeric number. And last week I mentioned that was the advancing stocks were only 2.4% above declining. This week there's a dramatic shift. The advancing number is now 26% above declining. That's significant, but that supports the breakout. That supports the increase of numbers. It's not only an increase in numbers, it's increased in buyer participation within the market, which supports an increased break. So it is, in a word, all positive to the upside. In the context of new highs and new lows, 3 weeks ago we had 32 new highs, 2 new lows. Last week, 28 new highs, 4 new lows that backed off. This week, 30 new highs, 2 new lows, so not as significant as advancing and declining, but generally it's a steady to positive trend. Other volumetric numbers that I follow is trading numbers, not advancing and decline, but just general trading volume numbers in the S&P 500. And I can say from this week to last week, there's a reasonable shift to the positive. So this is an upward moving market supported by trading volume in the context of a declining VIX. Let me jump across to the VIX, because as we know, it's a forward-looking indicator in the context of fear and concern of markets falling over. And I was only asked today, should I put a hedge within my portfolio? And I said, why? Tell me where the fear is. Why would you want to put on a hedge? Why would you want to waste money on a hedge? And he was going to buy puts when there's zero indication of the market doing anything other than falling. And when I say falling, I'm talking the VIX. If the VIX is in decline, the markets are in a rally. Inverse relationship, no fear. Of course, the market backed off in the last 2 days, and we can see a small rise in the VIX, but the trend of the VIX is where? Up or down? The trend of the VIX is down. I'll do some very crude channel lines. The trend of the VIX is down. There is no fear within the market. Therefore, you don't need to hedge. If you really need to, go put in some stop losses below swing lows, but there's absolutely no reason to waste money hedging the market at this point in time. Other indices which I really like to follow is IWM, and there's something quite interesting on IWM. It's kind of like it's not a three-wave structure yet, but if the market fell this evening, it would be a three-wave structure, and three-wave structures in bull markets are really bullish. So they can be three-wave structures. I'll draw the complete structure, or if they don't end up being a three-wave structure, they just do a partial test and then it moves to the upside. My belief is, or my expectation is, you're going to see that pattern this evening. It's going to do a test. The reason I say that, because I've seen this particular partial retest. It's on the ASX, it's in robotic stocks, it's in many instruments that I looked at today. There's this partial retest. Of course, I won't know, until this evening that is a higher low, because it's not confirmed until it breaks into a new high. That's my expectation. We'll see how that pans out, and that's a very bullish thing to occur on screen, if it goes up, obviously. Okay, so what else have we got on screen that's of interest? Well, we've got international indices which really need to be kept an eye on. And the two biggest ones are Europe and China. First of all, coming across to EWG, looking at the German market, all as I can see is a picture of bullishness. I've somewhat scribbled or taken off my, my patterns on screen. But previous scribblings on screen denoted a inverted head and shoulders pattern with the market breaking above the neckline, and that continues to be a true statement as it continues to break. The market itself is breaking trend, and we've covered this many times, so I won't linger on it. Coming across to the DAX, it's a similar picture. Inverted head and shoulders pattern, market breaking trend, and it's confirming a trade above its neckline. If I look at the volume of these indices in Europe, it's all very positive. In fact, a lot more positive than the United States. So there is nothing negative about a market which is breaking trend, going sideways and forming an accumulation phase. Coming down to FXI, which is obviously China. China traded on NYSE. We have mapped out this huge accumulation pattern for many, many days, weeks and months. And it's the same story where we've got a market-breaking trend, test, retest, confirmation, pullback in the context of a flattening to rising 20-period moving average. There is nothing negative about the evolution of the pattern that you're seeing on screen, and I say that it's a time to buy Chinese stocks, or you buy FXI if you want exposure to the Chinese market. Shanghai Composite has gone ballistic. Shanghai Composite is not only a market that's broken trend, but continues to do some extreme moves to the upside, and it's just so strong. Why is it so strong? Well, there's a very high correlation with metals and mining markets, and I would suggest to you that in the context of this particular market, broken trend, and it's following the trend of, or it's probably metals and mining following this market, to get it a bit more correct. Metals and mining doesn't lead the Chinese market. It's the demand for metals and mining due to the recovery of the Chinese market that's driving metals and mining. So this is looking really, really strong. It had gone too fast, too quickly, and you can see now that it's done what I would describe to you as a time correction. It's tracked sideways, come up to the moving average. Moving average has captured it. It might go for another week, but if the US starts breaking out in the next week, we'll see the Shanghai Composite continue to the upside. Just going to bring this out to a weekly chart. Just getting a much bigger perspective of the decline of the Chinese market and now what appears to be a very rapid recovery. It's very interesting because it's most beneficial for those of us that are in the Asia Pacific region. We rely on China as our major trading partner, and we need metals and mining to be purchased and exported. So this is all good news story for Australia. Just give me one moment. Last chart that I'll cover is EWU. EWU is the English market, FTSE, and once again, when you listen to the news, you'd think the way the news is presented that it's all shock and horror. Isn't it kind of confusing when you listen to the news and you see a chart? The chart's doing the opposite. I've already said this many times now, but the chart is reflecting that all the damage that the British are about to do themselves are already reflected in the chart down to the low, and now portfolios are obviously reweighting their portfolios globally and buying English stocks in anticipation of a continuing rise within that market. I don't think it's even an issue whether they have a hard, soft, whatever the English do. It's really not relevant. Maybe a short-term relevant, a day pullback, but that's it. So don't focus in on the Brexit, the day, as some major event and sell your shares. I would think that would be a very silly thing to do. Once again, just reflecting on all the trading volumes of all the indices that I'm looking at, I haven't finished yet, it's all very positive from last week. So some of them were semi-negative, but now they've flicked into significant positive numbers, supporting the contention the market's going to continue to the upside. Let's come across to Australia. I'm in Australia, and I'm speaking as if I'm speaking to people overseas, because I am. A lot of people are starting to listen to this in the US and Canada. So this is the Australian market, and I need to just point out that the pattern on screen is a time correction in the Australian market. It's going sideways. It was way above its moving average. It's now tracking sideways, and a time correction is same thing as a price correction. It didn't pull back. It just needed to track sideways for price to catch up. Time corrections are what? They're bullish. It's another example of a non, I suppose, conventional shoulder. That is the shoulder. You're looking at it. Just because it's not a pretty volatile thing that happened on the left, it doesn't have to be, and I'd anticipate this market to continue breaking to the upside in the not too distant future if the US starts pushing back up in the next few days, if not tonight. Coming across to our favourite contract, which is XJO, ASX 200. I'm not going to go back too far on what has occurred, but we know that the market had a resistance point on screen. That resistance point was put up months prior to it occurring. It touched that resistance point at 62, 65, 62.70. I've told you what I had done in the context of my portfolio, and that was I went to cash. Why did I go to cash? Because I needed to rebalance, and it was a good opportunity to rebalance. In the last 2 weeks, as that market has fallen, especially in the last few days, I am now 100% re-engaged with this market. Once again, if you look at what you're looking at on screen very, very carefully, what does it look like? It looks exactly the same as IWM. The market's come down, the market's gone. I would love to have seen a three-wave structure. It's a very bullish pattern. It doesn't have to do it. It still is a somewhat an in-spirit three-wave structure. If this market continues, it had a very, very strong recovery on the close in the last 15 minutes, half an hour. It had a very strong recovery. I had my finger on the trigger buying CBA, and so did other people in this room. And I thought they must be watching me, because I had literally had my finger on buying CBA, and order pops up for Richard, who's listening to me. So it's like we're working exactly together with a split second. So I bought some CBA this morning, and I bought a little bit yesterday to complete my exposure to the Australian market. So I'm 100% committed. Even if the market backs off from here, it's not even relevant to what I'm trying to do here, because all I wanted to do was rebalance. I needed a market to pull back, and it did. Perfect. And I'm completed what I would have, what I set out to do. It's all done as of this morning, as of this afternoon. So looking at this particular market, we can take it out to a bigger time frame for those that are interested, out to a weekly chart, looking at the big picture, and ask the question. Let me just contract the chart up. Where is this market going? Does it look bearish, bullish? What do you think? It's bullish. It's very bullish. It's maintaining this trend line, bounced off it. Very strong recovery out of an inverted head and shoulders pattern. Weekly chart, two small bar pullbacks, and it looks like it's about to go again. Is that guaranteed? Nothing's guaranteed, but that's what it would appear to be doing at this point in time. Okay, just give me one moment. I just need to make sure I've mentioned everything on the indices. I'm just checking my my volume behaviour on EWA, which is not super relevant to our local market, but it is quite positive. So just in summary, my belief is everything is well supported to the upside, both in the technicals and also the volume information that I follow to support that the markets will continue to the upside. Okay, now I need to justify where you should put your money if you're an investor, and I'll deal with individual stocks later, Alan, if that's okay. Now, Alan's asking why CBA a buy. I'll deal with that shortly. I just want to justify where you should be putting your money in the context of the different areas of economic strength within the North American and the Asia Pacific region, primarily Australia. So let's jump across to another chart so we can have a look at that.